Hello and welcome to the Relax, It's Retirement podcast with your host, Josh Leonard, where we talk about transitioning into retirement with intent. I'm Wendy McConnell. Hey, Josh, how are you?
Wonderful. How are you, Wendy?
I'm good. I'm always happy when I get to see your smiling face.
Oh, I appreciate that. I think yesterday I woke up and looking out at the grass, it was like a little crunchy, a little frosty.
Okay.
And then by the end of the day, it was 63. So
yeah, very lots of changes.
yeah. It's that Pennsylvania spring, right? So I'm sure it's the same for you.
Yes, I'm very close to Pennsylvania, New Jersey for sure.
Yes. But
I don't have grass, but yeah, it's cold.
yeah, it's cold, it'll warm up, that's how it is. The weather, we might say, is volatile, right?
Ooh, that's such a good word.
Do you like that transition there, Wendy? Because today we're going to talk about market volatility, right?
I was trying not to give it away. I was trying to act like, I was surprised and shocked. But
it's okay.
yeah.
Chop myself off at the knees if I need to, this is a big topic, right? Everyone, most people are quite worried at this point, and it makes sense, right? We have seen our retirement accounts, our portfolios grow over the last group of years, and now it feels like we're giving it back, and we don't want to give it back, right?
No. We want to keep that money.
That's right. And I think, what do we do, right? Do we sell it all, shove it under the mattress, and hope for the best? Which we hear a lot of times from folks, like, should I just leave the market and then come back when things are better? And the funny thing about timing the market, Wendy, is nobody calls you and says, hey, you know what? All is smooth sailing now, right?
Come on back.
Similar to the weather, right? We watch the weather and they say that there's a probability, right? We might be typically in the spring, it's going to be a little bit colder in the mornings. Come summer, it's not going to be as much of a fluctuation throughout.
Right.
We don't know that. There's a lot of uncertainty in the market, but I think we need to be able to properly frame it to stick with the long-term plan, right? So, I think right now, Morningstar has termed it the wall of worry, right? We've seen stocks go up. We're having a lot of changes going on in the new administration now. There's just a lot of uncertainty, right? So we're building up all of these factors that are concerning us, and we're unsure how that's going to impact the market over the long term. So, well, what do we do when we're afraid, Wendy?
Well, typically we do everything we can to quell our fears, which would mean selling everything. But I have a feeling that we're supposed to just relax,
right?
Be patient, calm down.
As a kid, at times I was fearful that there was alligators living underneath my bed, and the best way to hedge against that was to pull a blanket over. That doesn't help, right? If we're worried about factors in the market, we still want to stay invested. We want to make sure that our plan is properly structured. I think some of this is normal behavior, right? We always have a short-term memory and forget. When the market's up, we think it just goes up in perpetuity each and every year, very linearly and nice and smooth. That's not the case. Many times we have corrections throughout the year. Historically, we've had over 5% drops in 1 year. Pretty regular to even have a 10% drop in 1 year. What we're scarred from, or what we really are fearful of, is those major market corrections. So, when we think of even in 2022, when everything went down, bonds and stocks, with interest rates going higher, that hurt, although it was relatively short-lived. COVID was short-lived as well. The crisis that looms on the back of many of our minds is 2008, right? The mortgage crisis, where the market went down and it took a longer time to recover. We don't know when those things are coming, right? That's the point. If everyone knew, it would be priced into the market. Right now, we have a lot of worry making the market volatile in the short term. that might smooth out here once we get the rhythm of the new administration, for better or for worse, right? We catch that rhythm and businesses know how to operate. Things could end up smoothing out pretty quickly.
So talk to me about correction. What does it mean, and what happens when you have a correction?
Yeah, so 10% is a normal correction. That's a correction in pricing, right? So the market fluctuates. We see a 10% correction in prices. So,
but that's a drop usually, not when it goes up.
Yeah. We don't.
Okay.
We try to frame negatives more positively, Wendy. So
yeah, and sometimes it's not understandable.
we're correcting that your portfolio was overvalued. It is a correction.
I don't like those corrections.
Yeah.
But this is something that happens. It's not. It's not
regular.
Like cause to concern, like go crazy.
That's absolutely right. We could see it as an opportunity, right? So we could say, hey, in this correction, in this 10% loss, or if we're exceeding that, if we're losing more in the portfolio, we could see that as an opportunity to rebalance our portfolio, to pull some more out of the safer stuff, put it into the more risky stuff. Unfortunately, most folks do the opposite, right? We try to buy, or we tend to buy when things are high priced because we think, oh, it's doing really good, right? This tech stock I've heard all of my friends do so well at, I'm going to buy it now that it's really expensive, right? When we say it like that, it doesn't make any sense, but that's what we want to do, right?
Right.
You want to become an Eagles fan right in the fourth quarter of the Super Bowl when it's very clear that they're going to win, right?
No, I'm always an Eagles fan. Trust me. It's brutal.
It's been tough, but we'll take our victories, right?
Yes.
As the Steelers fan, it's been a little hard here lately.
It's been a while for you guys.
Well, we still remember the glory days, Wendy? We still remember the glory days.
I'm sure.
Much like football or sports, right? We need to rebuild over time. So maybe we have a correction by getting rid of some players that were good and worked well on the stat sheet, but maybe they're not a good fit in the plan overall. We've seen a lot of tech stocks correct in price, that the valuation's been super high over the last group of years as a lot of excitement has built around these companies. Well, now if there's new regulations or less funding going into that sector, the prices would correct to new assumptions moving forward. So that's the general framing around a correction.
Is there an assumption that they will go back up? I mean, I know you don't have a crystal ball, I know, but like generally things that go down typically come back up at some point, right?
As an aggregate, but individual companies can always, deviate from that. If we think of like the .com bubble in the early 2000s, right? Pets.com does not exist anymore, Wendy, but we have Chewy, right? So there was someone that came into that space and was very successful eventually.
Good analogy.
If we could have picked Amazon at that time, it was a great investment. What we see when some, tech stocks are the focus now, but it could be any industry where there's a ton of excitement, they start trading at a really high valuation. One of the things that we like to look at is price to earnings. So what is the price of the stock is a multiple of how much the company's earning, right? And some of these high-flying tech stocks, they might be trading at a 400 times multiple of what they're earning. That probably is not sustainable over the long term unless they have astronomical growth, right? So sometimes the price gets too far ahead or is too optimistic for the future of the business.
I understand. Okay. So it's like that's when you might want to make a trade, just like in football.
You're gonna calculate PE ratios now on the top holdings in your portfolio, Wendy. Is that what you're telling me?
Yep. I'm gonna ask I'm gonna ask Howie Roseman if I should make trades.
There we go. I think the other thing that has folks a little bit concerned is we've been spoiled now for about 2 years where our savings accounts have been yielding something again, finally, right? High yield savings accounts were almost close to 5%, some for sort of promo periods were as high as 5%. CDs exceeded 5% for a while. Those are starting to come down. We've seen the Treasury starting to lower that, paired with inflation lowering, right? Inflation lowering doesn't mean that things go back to their former prices, just the rate of it growing slows down. Well, much as if our savings account is not going to lose value, we're just not going to earn as much off of it. But that's another factor that people are a little bit worried about at this point. Hey, I'm not earning the same amount on that safe money as I used to, and the market's a little rocky. I don't necessarily want to take more investment risk at this time. That can drive a lot of worry as well.
Okay.
So I think the next question should be, Wendy, what do you do, right? So you're worried. Josh says not to worry, but I'm still worried, right?
Right.
Because I didn't eliminate all your concern, right?
No.
No.
Of course not.
No. Okay.
It's you. Come on.
Thanks, Wendy.
I'm kidding. I love to tease you.
But I think like anything that might stress us, sometimes logic comes into play, and maybe a friend or a spouse can say, "Yeah, but just do this," and you're like, "Yeah, but you don't hear me. I'm upset. I don't care what's logical," right?
Right.
Yeah. Let's set up the proper framework so that we can be patient there. So we have talked a couple times about buckets. Now, these aren't the buckets that you bring to the beach or to go crabbing. These are your retirement buckets. So the first one that we've talked about is your cash bucket, right? This is your safety net. This is 3 to 6 months worth of expenses that you have set aside. So we're not selling stock to go to the grocery store, or if the car breaks down, or the water heater goes, or the roof starts leaking. This is our emergency fund. If we know we need to replace a vehicle, let's say 3 to 6 months from now, or maybe even a year from now, again, let's put that money in the cash bucket. Let's make sure that we have that set aside. This enables us, again, to be a little bit more patient with the market. We're not worried that if we have a financial emergency, we need to pull all that money out right away.
Because we are prepared with 3 to 6 months of living expenses. It sounds very smart.
Yep. And during your working years, you have this power of having income coming in as well. Right, Wendy? So while you might need to deplete some of that savings, hopefully your income is enough to cover your expenses and then to help refill that savings bucket. Well, in retirement, we don't typically have the same level of income coming in, right? We might have Social Security. Maybe we're fortunate enough to have something coming from a pension. Whatever that difference is, we want to put 6 to 10 years worth of that difference in our income bucket. What that enables us to do is invest in very conservative things, typically a little bit lower yielding than stocks, but less volatile. We have less of the ups and downs of the market, or we completely eliminating, depending on the exact tools that we use. But that income bucket allows us to be patient. We know that we have 6 to 10 years worth of income. So even if we're completely fearful of everything that's happening today, well, we got 6 to 10 years for things to correct themselves there. So that income bucket, again, just like the savings or cash bucket, buys us some more time. The rest, the third bucket, well, we're going to invest and we're going to be able to be patient, right? We can watch it fluctuate a little bit. If we're feeling particularly bold, maybe we take some out of cash and reinvest into the growth bucket if we feel pretty comfortable in our position. But having those 3 buckets allows us to keep up with inflation over the long term by being able to stay invested. It enables us to have enough income to not worry about the short term, and enough cash to cover any of those unexpected emergencies.
And then we just pray that everything stays the same and we don't worry about the future, right?
We should always worry about the future, right? Things will change. We talk to clients all the time about, maybe tax issues, or how are we going to address this health concern in retirement? And I often make them reflect back to maybe their 20s or early 30s when they were starting a family, maybe bought their first house. And I'm like, how concerned were you about long-term care at that point? Or, did you ever think you'd be in this position where you have enough for retirement, right? No, you were watching the paycheck and you still had to go to the bank to deposit it then. That money could not clear the bank quick enough to make sure you have enough to meet the bills each and every month. Things will evolve over time, but having that long-term time horizon, in that case for a client, saving, even if it's only 5% or 10, ideally 15% of your income, might not seem like a lot, but that compounds over time. Using the bucket strategy, it's the same thing, right? We might feel like the whole world's ending today. We've felt that way many times in the past, right? I think COVID was one for me that was a little hard to coach clients through, right? Like everything's closing down with question mark of when it's going to open back up, right? Well, what do? We stick to what our time-tested lessons are, and we stay invested. And guess what? Man, things shot back up way quicker than we could have ever imagined. A lot of that was businesses knew, hey, the government is backing everyone up. Individual consumers, right? We passed lots of legislation to push money out to help fund the systems, to make everything sustain through that difficult time. The next tragedy is yet to be unseen, but as a society, we've been very resilient over time. The stock market is rooted in capitalism too. So whether or not you like leaders at one time or another, there's a lot of interest pushing that forward as well. So I think patience there and sticking with the course, time tested, has been the right strategy. People sometimes will go down a real big doomsday scenario. Well, what if there's a nuclear war? And then I hate to break it to you, but your US dollars are not really worthwhile if no one exists. So let's worry about things that are in our control.
Right.
If the whole country collapses, it doesn't really matter if you were underweight international equities or overweight, right? So there's things within our control and things outside of our control. We can focus our behavior and how we allocate our funds and how we plan to give us the highest probability of success. That's what we need to do, and then be patient, right? We're not going to work out for the first time and expect to be ripped for the whole summer by lifting weights once, right? We need to do that consistently over a long period of time. Your finances are the same way.
Yeah, everything makes sense. I don't like it, but it makes sense.
Yeah. Well, good things, you got to work for them, right?
Good things come to those who wait.
Yeah, and are patient. I mean, the Eagles didn't win the Super Bowl by just chance, right? They worked really hard. They built a team for many years that put them in a better position to win.
All right, I like it. Kids, let's keep going back to football.
Just giving you lots of kudos here. I'm hoping maybe it comes to the other side of the state next year. Maybe there's a little wind blows across the great state of Pennsylvania.
You never know.
It helps out the Steelers a little bit. But we'll see. So, I think that's it.
Mm-hmm.
Throughout the year, the market's going to go up and down. COVID is such a great example where we saw this huge shock to the market. The market dropped so quickly and ended the year up significantly. So be patient. We don't know exactly what's going to happen year to year. Let's make sure that our structure is set up properly so that we are positioned to make those gains when they're available, but have enough to cover our lifestyle in the short term.
Sounds like a plan.
And if you find a crystal ball that works perfectly, let us know. But nobody else seems to have
myself.
that.
Are you crazy?
Yeah. We had one on the conference room table, and for years I had a MacBook, and it, so the logo would reflect. So
yeah,
Apple's been a decent performing stock for a while, so that could be, it could. Anyways, we certainly don't know. We don't want to take outsized risks. In these times, we want to be prudent, and over time that'll pay off. So if you're worried about the market, what you could do is reassess your risk. We talked in the previous podcast about rebalancing your portfolio. Sometimes our growth components, the stocks in the portfolio, go up a lot quicker than the bonds. So with a couple positive years, we might be sitting on a higher stock balance than our bonds and cash within the portfolio. It could have gone out of balance. So let's review that, and let's review how you feel about risk over the long term. Maybe it's been a few years since you've done that exercise. So evaluating the risk in your portfolio, understanding where you stand and how that coordinates with your total plan sometimes can give you that peace of mind to be a little bit more patient in volatile times. So if you're listening to the podcast and you say, I think I need to do that, feel free to reach out. You can schedule a 15-minute call with me or a member of our team, and we can help walk you through how that exercise works.
Okay.
So Wendy, we'll be talking later. We'll review the portfolio. We'll let you know where you stand with risk and make sure.
Doing your tests.
I always test, right? I got to make sure that, as a partner in the show, I need to make sure that you're learning
coming through
too, right?
Loud and clear.
Yep. But so feel free to reach out. Wendy, thank you so much for joining again. And until next time, remember to retire with intent so you can live your golden years with the happiness and excitement you deserve.